I just learned that the average American pays 25% of their income in taxes. That means that if you work for 40 years, 10 of those years are spent entirely paying Uncle Sam. So in this video, I'm going to give you a checklist of 5 things you should be doing to decrease the amount of tax you owe. Number 1 is to contribute to your company's 401k plan. 401k plans are special types of investment accounts that allow you to reduce your taxable income. Let's take a look at an example. Let's say you make $100,000 per year and your tax rate is 20%, meaning you'll owe $20,000 in taxes. But if you invest $10,000 of that into a 401k account, your taxable income will be reduced by that same amount. So instead of paying 20% of $100,000 or $20,000, you'll end up paying 20% of $90,000 or $18,000, which means you'll save about $2,000 in income taxes. The second way to save on income tax is to contribute to an HSA account. And HSA accounts are special because they have a triple tax benefit. That's because HSA contributions are tax deductible, just like a 401k account. But you also get to invest that money tax-free, and later on, you can withdraw that money tax-free to pay for qualified medical expenses. So let's look at that same example where you make $100,000, but this time, let's say you contribute $10,000 to an HSA account. So right off the bat, just like with the 401k account, you'll save $2,000 in income taxes. And let's say that over the next 5 years, that $10,000 grows to $14,000. And sometime around year 5, you have a $4,000 medical expense that you need to pay for. In this scenario, you can withdraw the $4,000 for that medical expense without paying any taxes, and you can keep the other $10,000 in the account so it can keep growing tax-free. This is different from a 401k account because on the 401k account, you would owe capital gains taxes on that $4,000. And if you withdraw it before a specific age, you could owe additional taxes and penalties. So the third way to save on income taxes is through something called tax loss harvesting. Tax loss harvesting is when you sell investments that have gone down in value to offset the gains that you made from investments that went up in value. Let's say you made $10,000 investing in Nvidia this year and your tax rate is 20%, meaning you're going to owe $2,000 on that capital gains. But you also have other investments in your portfolio that have gone down around $5,000. You just haven't sold them yet. If you sell those investments and realize that gain, that means your net gain for the year will be $5,000 instead of $10,000. And instead of owing $2,000 in taxes, you'll only owe $1,000 in taxes, meaning you'll save $1,000. Additionally, some investment firms like Wealthfront and JP Morgan will do this for you automatically to make sure you pay the lowest taxes possible on your investment gains. The fourth way to save money on taxes is through long-term capital gains tax. Any money you make through investing is subject to capital gains tax, and there are 2 kinds, short-term and long-term, and the difference is whether you held onto your investment for less than a year or more than a year. And the difference between the two is that short-term capital gains are taxed at your personal tax rate, which could be as high as 37%. But long-term capital gains are taxed at a flat rate between 15 and 20%. For example, if you made a great investment that went up $10,000 over 11 months and you decide to sell, you would owe short-term capital gains tax on that investment, and it could be as high as $3,700. But if you wait just one more month, then those gains become long-term capital gains. And when you sell after the 12-month mark, then they would just be taxed between 15 and 20%, which could save you a lot of money. The fifth and final way to save money on your taxes is to start a business. While working for another company comes with salary and benefits, it does mean you're limited in the amount of tax benefits that you can claim. But if you start your own business, you'll have access to a wider variety of tax benefits that you can claim against the income that you make from that business. For example, if you grow on YouTube and start making money through ad revenue, then you can deduct expenses related to earning that revenue. That could include the cost of your home office, the cost of your computer, any software you use to edit videos, your camera equipment, and anything else related to making money on YouTube. Well, that wraps up today's video with 5 things you can do to decrease your tax burden, starting with contributing to a 401k, contributing to an HSA plan, taking advantage of tax loss harvesting, long-term capital gains tax, and starting your own business. If you want to learn more about starting your own business, I have 2 videos for you to check out related to Section 8 real estate investing and passive income, or subscribe to my channel where I post content like this every week.